If you're 65 or older in Canada, there are at least 5 bills sitting in your mailbox or coming off your paycheck right now that the law does not actually require you to pay in full anymore. And here's the uncomfortable part. Nobody at the CRA, nobody at your province, and nobody at your pharmacy is going to call you up and say, "Hey, you can stop paying this." You have to know it exists, and you have to ask for it by name. That gap between being entitled to something and actually claiming it is where thousands of dollars a year quietly disappear for otherwise sharp, careful people. I want to clear something up before we start, because it's exactly how people talk themselves out of watching the rest of this. If you own your home outright and you're comfortable, you might assume this list is only for seniors who are struggling. If you're living mostly on CPP and OAS, you might assume the opposite, that these are perks for homeowners with money. Both groups are wrong. Some of what I'm about to walk you through is worth more to the modest income retiree. Other parts are worth far more to the person sitting on a paid-off home that's doubled in value. I'll tell you exactly who each one helps most, so nobody watching gets to say, "Well, that one's not for me." Today I'm walking you through 5 bills you may be paying in full right now that you don't have to. Plain English, the exact form or program name for each one, and exactly what to do about it. Stay to the end, because the last one is the one almost nobody checks, and it's often the single biggest number on this entire list. Number 1. Your CPP contributions, if you're still working. What is it? If you're between 65 and 70, receiving your CPP or QPP retirement pension, and you're still working as an employee, CRA still deducts CPP premiums off every single paycheck unless you tell them to stop. A lot of people assume that once you start collecting your pension, the deductions stop automatically. They don't. The law treats this as your choice, not something that happens on its own. What is it worth? CPP contributions in 2026 run just over 5.9% of your pensionable earnings, up to the yearly maximum. For someone earning $50,000 a year, that's over $2,900 a year coming straight off your check for a benefit you're already collecting. How do you get it? There's a specific form, CPT 30, Election to Stop Contributing to the Canada Pension Plan. You fill out parts A, B, and C, give a copy to your employer, and mail the original to CRA yourself. The stop takes effect on the first day of the month after you hand it in, so timing matters, and you can't backdate it. One honest caveat here, because I'm not going to oversell this one. Stopping contributions also means you stop building post-retirement benefit credits, which slightly increase your future CPP payment. For most people still working part-time in their late 60s, keeping that money in your pocket today outweighs a small bump years from now, but it's worth 30 seconds of thought before you sign it, not after. Is this even legal, you might be asking, because it sounds like you're opting out of a government program. Completely legal. It's built into the Income Tax Act specifically for this age bracket. CRA isn't going to stop you. They're just not going to remind you either. Number 2, your property tax bill. What is it? Every province offers some version of a property tax deferral or reduction program for seniors, and this is where the real money on this list tends to hide. In British Columbia, the Property Tax Deferment Program lets eligible homeowners 55 and older postpone paying their annual property tax entirely, with the province covering it and settling up later when the home is sold or transferred. Ontario, Alberta, Nova Scotia, and PEI all run their own versions with different rules. On top of deferral, BC also has the Homeowner Grant, which knocks a set amount off your tax bill outright, and seniors 65 and up get a larger grant than younger homeowners. What is it worth? In BC, the Seniors Homeowner Grant is $845 in Metro Vancouver, the Capital Region, and the Fraser Valley, and $1,045 everywhere else in the province, on homes assessed up to $2,075,000. That's money off the bill, not a loan. The deferral program on top of that can mean not writing a property tax check at all for the year. How do you get it? Apply through your provincial tax authority. In BC, that's an eTax BC account, and the homeowner grant needs to be claimed separately from the deferral before the tax due date, typically July 2nd, or you risk a late penalty. Every other province has its own portal and its own deadline, so the action item is simple. Call your province's property tax office and ask by name whether you qualify for a senior homeowner grant and a deferral program. Here's the part I have to be straight with you about, because a viewer would catch it, and I'd rather tell you first. As of the 2026 tax year, BC changed the deferral program's interest structure. New deferrals now accrue interest at prime plus 2%, compounding monthly, instead of the old low simple interest rate. Amounts already deferred before 2026 keep the old terms. So deferral is still a legitimate tool, especially if you need the cash flow, but it's no longer close to free money the way it used to be. Worth running the numbers with your own situation before you commit, not after. Number 3. A chunk of your federal income tax. What is it? 2 credits stacked together here, and most tax software applies them automatically only if your birth date is entered correctly, which is exactly the kind of small error that quietly costs people money every year. The first is the age amount, line 30, 100, 100, available to anyone 65 or older. The second is the pension income amount, line 31400, available if you receive eligible pension income like a company pension or certain annuity payments. What is it worth? For 2025, the federal age amount is $8,790, and it's calculated at the lowest tax bracket, so it's worth up to roughly $1,319 in actual tax savings. It starts shrinking once your net income passes $45,522 and disappears entirely somewhere north of $105,000. On top of that, the pension income amount is worth up to $2,000 of eligible income, credited at 15%, so another $300 in your pocket. Most provinces layer their own age credit on top of the federal one, so the total is often larger than people expect. How do you get it? If you file your own return, confirm your date of birth is entered correctly, because that's what triggers the age amount automatically. If someone else prepares your return, ask them directly, was my age amount and pension income amount both applied? It's not a fight. It's one line you're allowed to check before you sign. And if you're wondering why this isn't automatic when the system clearly knows your age, that's a fair question. It is automatic in most tax software once your birth date is entered correctly. The problem isn't the CRA hiding it. The problem is a rushed preparer moving through a stack of returns or an online form where one wrong digit in your birth year silently switches this credit off. That's the whole reason to actually look at your return before you file it. Number 4. The OAS clawback, if you're anywhere close to the threshold. What is it? Officially called the OAS recovery tax. If your net income goes above a certain level, the government claws back part of your old age security payment, dollar for dollar, as your income rises above that line. A lot of people don't realize this is avoidable with a bit of planning, not something you're simply stuck with. What is it worth? For the 2025 income year, the clawback starts at net income around $93,454, and OAS is reduced by 15 cents for every dollar above that. If your income is high enough, your entire OAS payment can be clawed back. For a retiree sitting right around that threshold, a few $1,000s of extra reported income in 1 year can trigger a real, avoidable hit to next year's OAS. How do you get around it? This is where pension income splitting matters. If you and your spouse are both retired, you can split up to 50% of eligible pension income on your tax return, which can pull the higher earning spouse's income back down under the clawback threshold. It's done directly on your tax return using Form T1032, no separate application needed, just a box you check when you file together. The other lever is which account you pull retirement income from in a given year. Withdrawing from a TFSA doesn't count as income at all, so it doesn't touch this threshold, while an RAF withdrawal does. Timing which account you draw from can be the difference between keeping your full OAS or watching part of it disappear. Is this some kind of loophole, you might be thinking? No. Pension splitting has been a standard, fully legal part of the Income Tax Act for years. It exists specifically because Parliament recognized that 2 retired spouses with very different individual incomes were being taxed less fairly than a couple with the same household income split evenly. Using it isn't gaming the system. It's using the rule as it was written. Number 5, the one I told you to stay for, because it's usually the biggest ongoing dollar figure on this entire list, and it's almost never checked. Your prescription drug costs. What is it? In Ontario, the moment you turn 65, you're automatically enrolled in the Ontario Drug Benefit Program, whether you apply or not, covering thousands of prescription drugs on the provincial formulary. Every other province runs its own version of this, BC's Fair Pharmacare and Alberta's Coverage for Seniors among them, so if you're outside Ontario, the exact program name is different, but the idea is the same. Check what your province automatically gives you at 65. What is it worth? Under Ontario's standard program, seniors pay the first $100 of prescription costs each year as a deductible, then up to $6.11 per prescription after that. But there's a second layer most people never apply for, the seniors co-payment program. If you qualify based on income, roughly $25,000 or less net income for a single senior, or a combined $41,500 or less for a couple, that $100 deductible is waived entirely and your copayment drops to a maximum of $2 per prescription. For someone on multiple regular medications, that difference adds up to real money month after month, and it's not automatic. You have to apply. How do you get it? The base Ontario drug benefit needs no application at all. It kicks in the month after your 65th birthday. The seniors copayment program on top of it does require an application, submitted with your income information so the government can verify eligibility with CRA. If you're outside Ontario, the action is the same. Call your provincial health ministry or your pharmacist and ask specifically whether there's an income-based top-up program on top of the basic seniors drug plan, because in almost every province there is one, and it is not applied by default. Let me bring this back to a real person. I once worked through this exact list with a man I'll call Harold, 71, living outside Hamilton, still doing 2 mornings a week of part-time consulting work he genuinely enjoyed. When we looked at his situation, here's what we found. CPP premiums were still coming off his part-time paycheck, even though he'd been collecting his CPP pension for 6 years. His tax preparer had never confirmed the pension income amount was applied on top of his age amount, and he was paying the standard $6.11 copay on 4 regular prescriptions every single month without ever having heard of the seniors copayment program. None of it was fraud. None of it was some clever move. He simply hadn't been told any of these forms existed. We filed a CPT 30, corrected his return, and got his drug copay application in. Nothing about Harold's life changed. He didn't move. He didn't stop working. He didn't sell anything. The only thing that changed was how much of his own money actually stayed in his account. So here's what I want you to do this week, and none of it costs you anything. First, if you're still working past 65, ask your payroll department whether a CPT 30 is on file, and if it isn't, decide whether it should be. Second, call your province's property tax office and ask by name whether a seniors grant and a deferral program exist where you live. Third, the next time your return is prepared, ask directly whether your age amount and pension income amount were both applied, and if you're close to the OAS clawback threshold, ask about pension splitting. And finally, call your provincial drug benefit line or your pharmacist and ask whether you qualify for the income-tested top-up on your senior drug plan. One last thing, because it matters. This is general education, not personal financial, legal, or tax advice. Every one of these programs varies by province and by your individual income, so confirm your own situation with CRA, your provincial tax office, or a qualified advisor before you act on any of it. And if this helped you, send it to one person you know who's over 65. It costs you nothing, and it might put real money back in their account every single month.